Morning, everyone. Welcome to the market update for 2024. My name is Cole Pearson. I'm grateful to have you with us. As we do, let me open us in a quick word of prayer before we get to our time together today. Let's pray. Heavenly Father, Lord, thank you for a new day. You tell us in your word and Lamentations that your love never ceases, that you give us new mercies every morning. So, Lord, we thank you for that today. Thank you for each man, woman, and family represented on this call as we spend a few moments talking about the markets and finances and these things that you've given us to steward. Lord, help us to do so with wisdom, to do it wisely. Give us the words to speak and the ability to communicate clearly what you would have us share this morning. But Lord, we thank you, we love you, and we ask this in your son's name. Amen. All right. Well, again, welcome to our Q2 OneAscent Market Update call. My name is Cole Pearson. I serve as the president of OneAscent, and we'll be joined by Nathan Willis. Nathan is our director of portfolio strategy. He leads our asset allocation and our manager selection committees. Will be giving us an update on what's going on in the market. If you have questions at any time throughout the call, you can send those by email to info@oneascent.com. You can also use the chat, the Q&A function built there into your Zoom portal. But we'd love to answer any questions at the end of our time. We do have these calls every quarter. It's the third Tuesday of every quarter. So you can go to market calendars for July 16th, and we'll be back, and we'd love to share with you again in a few months. So with that, before we jump into our market piece, we always want to remind you just of what we do and why we exist. OneAscent exists to help investors align their values with their investments. We call that value investing. So real quickly, the way we approach investing is first, we eliminate certain companies whose products or practices cause harm. We simply remove those from our investable universe. We're not going to invest in those companies. But the second step is evaluating to make sure the things we are investing in meet our investment objectives. It needs to be a great investment. But finally, for us as values-based investors, we're looking to elevate those companies who make the world a better place. So eliminate those that cause harm, make sure they're great investments, and elevate those that are bringing blessing. The way that we do all of this work is through our proprietary Elevate tool. So you can see some quick screenshots here that over the last few years, we've built out a proprietary system that helps us do this in a world-class way. So just a quick few numbers for you. In our tool, there are 8 different eliminate issues, 8 different categories of things that we're looking for to avoid. It could be broken out even further into 47 sub-issues. Putting down into the details there. Total, we cover about 70,000 issuers. So companies who may issue equity security or debt security. And that's 3.9 million data points that are running through this system on a nightly basis. So this is how we do values-based investing. And so if this is something that you're interested in and you want to learn, is your portfolio aligned? If you're an advisor on the call today, you can visit align.oneascent.com. You can request access. You can see that far left image there. There's a request access button. That's a tool built for you as the advisor. If you're a client on today's call and you work with an advisor at OneAscent and you'd like to have this conversation, we would encourage you to speak with your advisor. Ask them about the Align tool and how you can identify your values and whether or not your portfolio is aligned. So that's why we exist. Ultimately, we have to be great and do all the things that we covered just about. Really, our heartbeat is value-based investing. But what happens in the markets do matter. So with that, I'm excited to turn it over to Nathan, our director of portfolio strategy, and give us an update on what's going on in the market in Q2. Nathan?
Thanks, Cole. It's great to be with you today, and I look forward to our conversation. Today, we're going to cover 3 main topics. First, we're going to do a review of the markets in the first quarter. Second, we're going to go through our navigator process and talk about how that informs our investment outlook. And then finally, we're going to answer the question, what should I do in my portfolio? And we'll talk about what we're doing in our portfolios. So first, let's just dig in with the first quarter investment returns. So your portfolios were driven this quarter by stocks, particularly U.S. large cap stocks, as the S&P 500 was up over 10%. Small mid cap stocks earned money, but a little bit less. And international stocks also earned a little bit less. Finally, bonds adjusted to the prospect of higher interest rates, where the Bloomberg aggregate bond portfolio index lost money, but high yield bonds gained money as the recession odds declined and company defaults became less of a worry. These themes continued from the trailing 1 year. US stocks have dominated recent returns, and bonds have kind of come back to a positive return period after 2022. They've kind of adjusted to a period of higher for longer rates. So what I want to do, though, is if you look, you can see over the last year, and this would happen if I showed you a 5-year or a 10-year chart as well, the S&P 500 dominated returns. And so what I want to do is I want to talk about that, and I want to talk particularly about outperformance of US stocks over time and put it into historical context. So the way we're going to do that, we're going to talk about international performance cycles. So this chart shows that US and international returns move in cycles. So the green part of the chart is when the US stocks, the S&P 500 is outperforming and what dates. The blue is when international stocks were outperforming, and it shows how long and by how much magnitude. And so there's 4 points I would make on this chart. First, US and international returns move in cycles, okay? Second, over the long term, the US has outperformed the international markets. However, part of that is due to a very long period of US dominance just came to an end at the end of 2021. And then finally, given that and given these historical patterns, there's a decent likelihood that international stocks will perform very well going forward. So in order to look at what drives these cycles, we need to look at valuations, not just price returns that we show on this chart. So let's look at valuations, and the title of this chart is that valuations matter. What we see here on this chart is the valuation of the US market in gold and the valuation of the non-US market in blue. And you can see over time, the entire period actually, the US has been more expensive than the international markets. This makes sense because the US economy and the US market function better by most accounts than international stocks. However, we need to understand that there's a relationship between these two, and that relationship fluctuates over time. And so the bottom half of this chart illustrates that. This shows the S&P 500 valuation minus the non-US valuation. And you can see a couple of peaks. First of all, there was a peak in US valuation during the tech bubble, and then there was a trough in US valuation during the financial crisis in 2008. And then there was a peak that my chart covered up a little bit here in 2021 at the end of the US dominance we saw on the prior chart. And you can see right now, US stocks are a good bit more expensive than international stocks. So the US had a huge premium in the tech bubble, a very, very low premium during the global financial crisis, and is now at a big premium again. So let's look at these valuations on the prior chart we just looked at and see what that tells us. So during the tech bubble, US stocks were twice as expensive as international stocks. And what happened after that? You had a decade that was referred to as the lost decade for US stocks. After the end of this period, US stocks actually lost money for 10 years in a row, whereas international stocks outperformed. But then at the end of that US outperformance, which culminated near the bottom of the global financial crisis, there was a very, very small premium between US stocks and international stocks. And that led to a huge period of outperformance for the US over 15 years. The US really dominated returns. That left us with 2021, a huge premium, but today the premium is still very high. US stocks are almost twice as expensive as international stocks are. So this tells us a couple things. We think because stocks move in cycles, there's a pretty good chance of international stocks performing well over the coming years. I also wanted to show this, not just to make that point, but to talk about this as an example of our framework for allocating investment portfolios. But there's also the logical question, why do we even need a framework? And so to answer that question, I'm going to go to that great investment philosopher, Yogi Berra. He says that baseball is 90% mental and the other half is physical. And it's kind of a humorous anecdote that says, the physical is very, very important, but it can be completely dominated if you don't have your mental set up right for baseball. And I would kind of take this and apply this same kind of logic to investing. And I would say that investing is 90% discipline and the other half is planning. So your awesome planning can be ruined if you don't have good discipline. Investing can be a mental and emotional roller coaster if we don't have discipline. We have discipline and we have a framework. So what we're going to do now is walk through that framework. The framework is our Navigator Outlook, and we look every quarter, we look every month, all the time at these four factors. We look at the economy, we look at market technicals, we look at investor sentiment, and then we look at valuations. So today we're going to focus and do a little bit more of a high-level view on the economy and on valuations, see what it tells us about the short term and about the long term. So first of all, the short term, the economy has really accelerated, or rather, forecasts from Wall Street economists have accelerated. So there are two lines on this chart. The gold line is a survey of Wall Street economists, what they think global US growth is going to be in 2024. So you can see last August, it was very minimal, it's 0.6%. And now those growth estimates have gone up to 2.2%. In fact, some data came out the last couple of days, it's even higher, okay? At the same time, because of this, the recession probability has dropped from a 2/3 probability of recession down to 1/3 probability of recession. This has happened for two reasons. Number one, the economic data has improved, but more importantly, back in September or October, the Fed really pivoted from saying we're going to keep rates higher for longer to saying we're going to cut rates most likely in 2024. That really drove growth estimates and it drove recession probabilities down. So in the short term, things are looking really good for the economy. But let's anchor to the long term with valuation. So we talked about US stocks being more expensive than international stocks, okay? This is another way to look at that. This is sometimes referred to as the Buffett indicator because it's one that he uses, but what it does is it measures the total market cap of the US stock market relative to GDP. So the companies that are making the output, their valuation relative to the size of the economy. And one of the things that is a pretty solid principle is when this gets really high, that means maybe returns aren't going to be great going forward. You saw it had a big peak right before the tech bubble. And one thing I would note on this chart is that it was fairly low during the global financial crisis, and this ratio has roared back. So stock market, stocks, investments have gained a lot more in value than the economy has increased in output. So this measure suggests that maybe the stock market's gotten a little bit ahead of itself relative to the economy. We think returns are probably going to be modest over the coming years for the S&P 500. So contrast to that, we talked about international stocks, but I would also point out that small cap valuations are pretty compelling. And the bullet point here at the top says particularly profitable companies remain compelling. And I wanted to talk about that for a second. I have two lines on this chart. The blue line is the Russell 2000, which is one of the really well-known small cap benchmarks. And then the gold line is the S&P 600. Standard & Poor's does a large, a mid, and a small cap, and the S&P 600 is their small cap benchmark. And you can see these two lines were really similar till about 2013. Since then, the Russell 2000 has gotten a little bit more expensive, such that it's maybe a touch more expensive than average right now, whereas the S&P ratio is right about at average. And so I want to talk about why this is. The S&P Index Committee has a profitability factor that they use when allowing companies into the index. So what you've seen here is that unprofitable companies, or an index, the Russell 2000, with fewer profitable companies, has gotten more and more expensive over the last decade. And so what we want to say is not only are small caps attractive, but in particular, small caps which are profitable are very attractive. That's the really most important point I want to make on this slide. The other point I want to make on this slide is there is no such thing as passive investing. Even if you're using an index, the index creation matters. You need to pay attention to what that index does. In this case, it makes sense for us to think about an index which includes profitable companies as its focus. So I wanted to point that out in terms of how we look at this framework, not just kind of from a macro standpoint, but when we get down to how we actually implement our investments. So let's go review our overall Navigator outlook. So we showed the economy is doing great and that valuations are really not that fantastic for the large cap stocks, but they're okay for the rest of the market. I won't spend a lot of time talking about it, but the technicals are positive for the stock market, although there's been some short-term bumps in the road in the last week or so. And then consistent with the last several quarters, investor sentiment is not very positive in our view. And what we mean by that is it's very, very bullish. So there really aren't a lot of bearish people left to buy new stocks. And so you like to have people who are not bullish. And we don't really have a lot of people that are not bullish. And so we think there's less upside in the short term based upon that measure. So, all right, so I've shared with you our framework. So the logical question is what to do about it. So I'm going to give you some advice, which I think is sound. And I'm giving you this advice in particularly this quarter after the stock market has done really, really well, because I'm going to talk about what happens when the stock market's not doing well. And it helps to be reminded what decisions we need to take when things are looking good, when things are going to go bad. How do we need to make sure we think about it? So let's talk about staying invested during volatility. So what I'm showing you here is two charts of the S&P 500. First of all, these are just price returns. I ignored dividends for this because what I want to do is talk about price returns if you miss the best months for the market. So the gold line is the S&P 500 if you missed the top 10 months over the last 10 years. And the blue line is if you just had the S&P 500. So over the last 20 years, the S&P 500 price return has been 8.25%. But if you missed the 10 best months, you missed 2/3 of your return, right? Your return drops to 3.5%. So that's stunning. It shows that you need to remain invested, but it's even more important to look at when those strong returns happen in order to maintain our discipline. So when do those great returns happen? So I've put a chart of those 10 best monthly returns from April of 4 through March of this year. And what I want to do is go through them and talk about you need to maintain your discipline through a crisis, a global financial crisis, a pandemic, and an inflationary scare. So first of all, let's look at the global financial crisis. Two of the best months occurred in March and April of 2009, right at the depths of the global financial crisis, when a lot of people thought the financial system was at risk and there was a lot of instability. Next, we move on to the pandemic. So the best return on this chart is April of 2020, right after we hit the peak pandemic numbers. The market bottomed, I think, on the 23rd of March. Nobody knew what was going to happen. Death rates were what we all talked about. It was just a very, very ugly time. But the market returned 12%, 12.7% during that month. Then again in November of 2020, as things started to become a little bit more stable, you had a great return. Then we hit 2022. We got hit with inflation. And we had a horrible downdraft the first half of 2022, but a strong recovery in July of 2022. Another downturn in the summer, another really strong recovery in October. And then throughout 2023, as we began to recover, we had a really, really strong return in November, right after the Fed kind of talked about the fact that they were going to pivot and cut rates. So if you step back and look, 7 of the last 10 best months all occurred in the midst of a crisis, a pandemic, and an inflationary scare. So the moral of the story is you need to stick with your discipline. Follow Yogi Berra's advice and focus on the mental, focus on your discipline and your emotional well-being, and that will keep you invested. So I've talked about keeping you invested, so let's talk about how our portfolios are invested. So we usually talk about this way. We have 5 different risk-based models, and we focus on the moderate model. And what I'm going to do is just pull the laser pointer here just to make it easier to show. One thing to note is that we are slightly overweight equities. So the benchmark for this portfolio is 60% stocks, and we're at 62% stocks. So slightly overweight based upon the good short-term developments in the economy. Second is our large cap exposure. We're a little bit underweight. Normally we would have about 20% in large caps. So we're a touch underweight large caps. And then we're overweight small and mid caps because we see really good opportunities there. And then between international developed and emerging markets, we have 20% invested. So we have more invested outside of the US large caps in small and mid caps, and we have more invested outside the US than we have in US large cap stocks. So we're very, very diversified, which is one of the core tenets of our investment philosophy. We're also very diversified in our bond portfolio. We have government bonds, corporate, high grade and high yield bonds, and securitized bonds. So we're very, very diversified. we're able to take advantage of whatever may happen in the market. So without further detail, what I want to do is pass the call back to Cole and see if we have any questions on the call.
Thanks, Nathan. Again, if you've got questions, you can send those by email or to info@oneascent.com. You can send them here via Zoom. While those questions are coming in, Nathan, I've got one for you. I know probably on the top of everyone's mind. It's an election year, and we're kind of about to kick off in full gear with an election year. So what impact will the election have on portfolios?
Yeah, we actually wrote about this in our weekly blog that came out yesterday. I would actually answer it by saying it's the opposite. So the better question to ask is, what will the stock market do to affect the election? And so this is a chart we showed yesterday in our blog post. And what this shows is that when the stock market is good, the incumbent party won. And when the stock market was not as good, the incumbent party lost. So that would bode for a Biden win. Now, one big caveat to this is another thing that can be a big driver is inflation. During inflationary spikes or inflationary periods, the incumbent tends to lose because they get blamed for inflation. So I'm not an economist, but like an economist, I've just given you two opposite answers. There's something that bodes well for Biden and something that bodes well for Trump.
And if you want to see that commentary that Nathan just referenced, you can hit our website and read that in full. Another question that we just got in, Nathan, can you talk about cash and a little bit with what interest rates have done? Where does cash come into the planning or the discipline, perhaps?
Yeah, well, cash is very attractive right now with rates being high. The problem with cash is that it tends to make you feel safe and secure. And investing is oftentimes best done when you're not particularly safe and secure. Investing takes risk. And so what I would say is don't have any more cash than you need for any needs you have in the coming months or years. Remain invested in the portfolio. You're going to be better off because what'll happen is if you have cash and the market goes down, you're not going to say, oh, I was right, I'll get back in the market. You're going to say, see, I'm right, we should stay in cash. And then the market's going to go up and you're going to miss it. Unfortunately, we have a very hard time making that decision to get back into the market when we get out.
Let's see. Another question, Nathan, is about what's going on in the Middle East. What's going on with Iran? It's been in the news a lot. Any impact that might have on our global asset allocation?
Yeah, so we're thinking about it a lot. Two key things that may happen. Number one, oil prices are up several percent from about 75 to the low to mid 90s. That is going to add to inflationary worries. One of the things that we are doing about that is that we're thinking about how we diversify our portfolios. The traditional diversification of portfolios is in bonds, and we do that, but we also have a set of portfolios that use a broad set of alternatives. And it's interesting to note that I don't want to brag because it's not because we've done anything great, but through yesterday, our alternatives portfolio is up a little bit more than the S&P 500 is up this year. So the S&P 500 is up 7%, and our alternative portfolio is up just a little bit more than that. And a big driver for that is one of our allocations in that alternatives portfolio is gold. And gold's up 15% year to date. That's about 20% of our alternatives portfolio. We also have broad commodities as a hedge against inflation. And so oil is benefiting our alternatives portfolio a little bit, but gold is one of the things we have in here that doesn't work a ton of times, but sometimes when you need it, it does work. So again, the theme is that we're remaining very, very diversified, and we're thinking about different ways to diversify a portfolio.
As we maybe wrap up, that might be a last good segue. Talking a little bit more about alternatives. We spent some time talking about the economy and equities and fixed income. We even had a question about cash. Can you give maybe a quick 30-second on what are alternatives and what role do they play in a portfolio?
Yeah, sure. So when we think about alternatives, what we are looking for is things that have very low correlation to the traditional stock and bond markets. They have different return drivers, and they may offer some diversification. So one One allocation that we really like to use is managed futures. That sounds very sophisticated, and it is. It's a bunch of PhDs with really, really sophisticated computer models. And what they do is they seek to follow trends that emerge in the markets, wherever, however those trends come about. And some of those are short term, some of those are intermediate term, but it is a very different return driver than our stock's going to do better this quarter because earnings are improving. So that's one example. Another example is event driven. So if you think about a merger, a merger will happen, really it'll happen or not happen based upon the legal outlook and the ability of the companies to finish the merger. That's a different return driver than our earnings going to go up or down. So those are a couple of examples of what we use in our alternatives portfolio, but the intent is to have a diversified set of returns that will complement both the stock and bond portfolio.
Well, we try to keep these calls relatively brief, but hopefully packed with lots of great information. So hopefully you enjoyed what we shared today. And if you have questions or would like to learn more, we have lots and lots of resources to do so. The Navigator Outlook, which is the full deck that we put out each month, is on our website. The commentary that Nathan alluded to, we put that out every week. Also on our website, we'd love to have you access those resources at investments.oneascent.com or send us an email. We'd love to share those things with you. But I want to conclude our time, Nathan, with thanking you for your wisdom and expertise, and for our listeners for spending a few minutes with us this morning. We thank you for your time and trust, and look forward to seeing you back in July for our next quarterly call. So that'll wrap up our time, and hope you have a great rest of your day and a blessed week.
Thanks.
All right, bye-bye.